Creating a successful fintech is super tough. I've been fortunate enough to be part of the journey for 2 fintech unicorns, and I've become obsessed with cracking the code. Join me and my guests, all experts in their domain, as we attempt to find the secrets and share them with you. Welcome to the Hive Mind. Hi everyone, I'm back for another remote Hive Mind podcast, and today I've got with me the founder of Minna Technologies. Minna was recently acquired by Mastercard, and they were a subscription management tool that I followed for some time. It's a really valuable tool that I always think should be embedded in most technologies. So Joakim, thank you very much for giving me some time today.
Thanks for having me, James. Pleasure to be here.
So talking to founders, what I love about this opportunity is getting the warts and all appraisal of the journey, because it's never smooth. It's never a straight line. There's moments of triumph and some bumps along the road. But could you start off by telling me, how did you come up with the idea for Minna initially?
Now we're going a long way back in time. So a trip down memory lane, it's actually kind of cliche. So I started Minna while I was still at university. So now we're looking back in 2013. And I was a first year graduate, and I had a couple of awkward experiences. One of them being I was supposed to buy my groceries on a very limited student budget. And I was so confident that 24 hours earlier I had the funds to go and buy groceries, right? But at the point of cashing for the groceries, I was out of funds. So the payment was declined. And looking at my statement, I realized that I had a few subscriptions that just charged me without any notice. And that was annoying. But the final trigger to start a company was simply a very bad cancellation experience. So getting rid of those subscriptions, one of them took me more than an hour, standing in the phone queue, getting redirected to another department that they just wouldn't let me go. So, hey, can I create a software where I, as a customer, can control all of my recurring spend in one place?
I mean, I remember, as you know, I've been a massive fan of Minna for ages, but I remember when I first learned about your technology, I actually did a manual audit of my own spending, and I had something like 13 or 14 things on my account, and that was when I realized you had a great idea on your hands. So I think everyone's had those terrible experiences.
I think when we started, the average in Europe was 11, and that trend has only gone up since.
Yeah. So when you started off, you obviously had a co-founder as well. Did you know each other beforehand, or did you kind of go out on the hunt to identify a technical co-founder? What was that journey?
So we were 3 co-founders formally. When I came up with the idea, I was all by myself back in 2013, and I actually participated on the Dragon's Den TV show, Swedish version. And I also participated in a few other of these startup competitions, pitch your idea, yada yada, small prize check. And at one of those events, the host of the evening was a gentleman called Jonas Carles. And the first photo of us together was when he was handing me the first prize check. But a few weeks after that event, we kept on talking and he ended up joining the journey. So he was the hipster, so to speak. Jonas was COO and head of all things culture and people. He had one requirement before he decided to join, that he also wanted to have technology in-house. So he recommended Marcus, who then became the third co-founder and CTO. So at that point of time, it went from being just a hustler to a hustler, a hipster, and a hacker. And that's a more famous recipe.
That's great. I mean, I've seen quite a bit on LinkedIn and content discussion around the benefits of being a solo founder versus a co-founder. Like with the benefit of all of that experience, what are your views on kind of the merits of either approach now?
There are no benefits with being a sole founder. I think it's very naive and I would call it blind to think that you can pull it off by yourself. I never had the intention to do it by myself, but you got to start somewhere. So that's one very firm advice, that if you are a solo founder, that should be your next priority. If I were to participate as an angel investor in any company and they're a sole founder, I would not invest.
Let's unpack that a bit. Tell me more, because you're not hedging your bets there at all. You've got a very strong opinion.
Absolutely. And if we should unpack that a little bit, I think it correlates with your ambition. So if you want to scale a business, the organization would scale exponentially, but you as a human being can only scale linear. So if you want to follow the trajectory and reach a rapid scale, you would need to get bigger than yourself, right? And it's also just a matter of time before you go from being a generalist who is decent at everything until you need specialists. And especially in the world of technology, would a venture company invest in me as a non-technical founder to build a technical company? It's just unreasonable risk for any external party. And especially when we're talking fintech, you want to sell to the big banks. And if you want to surpass their compliance and IT-Sec and audits and ISO compliance and everything they throw your way, you won't do it if you don't speak their language.
But why a co-founder as opposed to just, getting capitalized and hiring normal employees?
Let's refer to it as healthy idiots. In the early days, I preferred to work with the people who wake up at 3 a.m. and think about that annoying bug or that line of code and why didn't it work. And I don't think you get that from people that don't have the risk appetite of acting as a founder. There are simply different risk profile on employees versus founders. And you want people that are ready to take the risk and walk the extra mile in the early days.
Yeah, so it's an issue of the obsession that you can draw out of a co-founder that you just can't expect from a payroll.
And also sharing the pain. Loneliest at the top is there is some truth to that statement. And having a flat organization with your initial team where you can actually share things gives you a lot of benefits. If they were formerly your employees, you wouldn't share the rough times in the same way.
Yeah, I mean, you raised an interesting point that as an investor, you wouldn't invest in a solo founder. But I saw a statistic the other day that huge amounts, some of the main reasons that companies fail is because the founders break up, and I can imagine that's pretty difficult. I mean, how did you guys deal with disagreements? Because that's part of any relationship.
Very good point. And I'm lucky to be here and call both of my co-founders very good friends. Well, this journey ended up in a good place, but of course we had our hiccup through the years. We never had any holding or ownership conflict, but there are different tongues and different priorities when you have accountability for different departments. So me as a salesperson, of course, I would like to promise the next feature or the upcoming functionality in the next 8 weeks, but you know that the technology guy is going to say 8 months. So how do you balance things? And also just the thing of communication when you do business. My perspective as more of a people person is that in good times you do business with people you like, and in bad times you do business with people you like. Technological perspective may be that you need to have the superior technology in order to win the deal. And none of these are wrong, but there is always a balance in between them.
So, do you have any scientific way for identifying a founder, someone that perhaps that you know that you're going to get along well with, or perhaps complements your weaknesses?
Those are two different criteria, and it's really hard to be super rational on them because you want to spend the time with the person you get along with, but then you expose yourself to the risk with someone thinking in the same pattern as you are. So I think that's a challenging puzzle to solve. So with Minna, I did not know Jonas or Marcus at all. We were not private friends since before. They came into the business very much complementary to the skill set. The company that I'm running now, I started with a friend. So give me 10 years and I can compare the two journeys.
We'll schedule that in the next podcast. So, talking about fundraising again, I know I'm going straight for some of the contentious issues, but again, I think there are a lot of stories of founders out there that kind of dived straight into taking external money and then didn't realize that it's a merry-go-round that's not always easy to get off. And I appreciate that you did that. You did take external money with Minna, and also for your new venture, kind of offering up a slightly more nuanced view. Like, what do you think of fintech or technology founders taking outside money, and what guidance would you give them?
That's another great question. There are pros and cons with each of the solutions, right? So we raised just north of 30 million euros over the time with Minna. And if you end up in a situation where the amount of money raised is some form of a definition of success, you're going down the wrong path. And it's very easy to fall down in those media outlets who just pitch you as a hero because you managed to raise venture capital. I think that's also a 25-year-old Joakim doing some mistakes, right? It also comes with a cost. It always does. When everything is going smooth and there is smooth sailing, nobody's going to challenge you. But as we all know, a journey from A to Z comes with obstacles and hiccups. And those are the times where you want the good guys on your cap table. So in my new venture, I'm actually building it much more bootstrapped. So we're doing more loan financing and more debt financing than venture capital for good reasons. Going back to technology companies, especially when you're selling to banks, you're looking at what, a 2-year build cycle for your first viable product, and then you've got another 2-year sales cycle, and then you've got another 1 year of integration timeline because you're selling into an incumbent. So you're looking at revenue, what, 5 years down the line? Then you're going to have the perseverance and longevity to actually pull that off. And then you need venture capital because you also got to carry the cost of 50 FDs building your product. So I think it's inevitable. In enterprise software, it's very hard to succeed without external funding.
Yeah, but it's also about having realistic expectations, isn't it? I think there was a point probably in 2021 before it unwound a little bit where, crazy promises were made about, taking companies from X revenue to Y revenue in very short periods of time. And what you've highlighted is something that I've discussed with guests time and time again, which is the length of the buying cycles, particularly in infrastructure and also particularly to banks, isn't always quick, is it?
No, absolutely not. So what's the normal market ratio that you want to raise funds every 18 to 24 months? That's not even a sales cycle. So from the moment you close your previous round, you're barely going to realize any new revenue until you need to raise your next round. And then you're painting yourself into a corner because your latest investor is going to expect a multiple and a valuation growth. But raising big money on big valuations is a recipe to make someone disappointed in the next round. And that comes also with the terms. So most firms that raise super big tickets at high valuations, what we don't know are their shareholding terms, right? It's easy to raise a lot of money if you gave them 5x liquidation preference and other nasty terms. So don't get blind by the amount someone receives because they may get abused.
Yeah. So I mean, Minna took 2 rounds, didn't you? Was it 8 and 18? Sorry, I'm going to be slightly off there. You can correct me.
No, you are almost right. So our seed round was actually provided by Swedbank, roughly 1.5 euros. And then we did a Series A, who's led by Zenith Venture Capital out of Stockholm. And then a Series B led by Element Ventures, which is now 13 Books Capital out of the UK.
So did you feel a lot of pressure to take more money? Because actually those raises they're really healthy, but they're not as giddy as some.
This is also a thing with the banking technology, given that you have the long sales cycles, you don't have that rapid scalability or blitz scaling. So the investors that goes into this line of business, they should not expect 100x return because these companies, by the nature of their customer, don't have a 100x growth rate. So I think having the mutual understanding with all of your cap table about the reasonable expectations is critical.
And I mean, the main focus of this podcast is around sales and marketing. Now, again, if I was to kind of just pull out from the environment contentious topics, one of the big ones is around the efficacy of outbound, the importance of content. How did you build the revenue machine? Because you described, you were the commercial force behind Minna as a business. How did you build that engine?
I think cold outreach is just pure bullshit. You're not going to get a lot done in enterprise with doing cold outreach. Starting some form of a chronological way. Our first enterprise customer became Swedbank. They got a deal to use the product for free for 3 years. So we gave away our product for 3 years. But that ended up being invaluable because they also invested in the company. They joined the board and they gave us super good feedback on how a bank's buying cycle actually works and what material they expect to see. So as a consequence of giving the product to Swedbank, we managed to sign Danske Bank, which is the biggest bank in Denmark, OP Bank, which is the biggest bank in Finland, and Sparbank 1, which is the second biggest bank in Norway. So in the matter of 1.5, 2 years, we went from having no customers to having the biggest bank in each of the Nordic markets. And that was simply a consequence of getting a first reference client because no bank want to go first, but nobody want to be the last one either.
It's a huge issue. The lighthouse customer, as I describe it, trying to get the first, because banks intrinsically aren't early adopters. That's quite a contradictory statement, isn't it, in financial services?
Yeah, well, they want to appear as quick movers and digitally mature and innovative, but that's in many cases in innovation theater. And then you got to respect the dynamics of the market. So in the Nordic region, the banks don't really have a problem to collaborate with each other. So we got the peer-to-peer payment system, which is produced by the banks in a joint venture. You got the digital signature and identity system produced by the banks in joint venture. In the UK, well, if you go red, you will not sell to blue. Maybe you know what banks I'm referring to. But the level of competitive attitude is a lot higher, so it's harder to win all logos in the UK because one is resistant buying something that the other one decided to buy.
It's a really weird phenomenon, and I'll tell you what, I came across that quite a bit at Mambu, where some of the big banks would say, well, if we buy, we want exclusivity. And you think, I mean, it's slightly different for Minna, but in that case, you'd ask them, what competitive advantage do you think you're drawing down here? It's almost like a gut reaction, isn't it, by some banks? Culturally, they're just like, I want it, so no one else can have it.
Yeah, and I think it's devastating for the company that provides the product as well, because in reality, you get benefits of scale, and the more customers you have, the more resources you can put to enhance the product and the quality and the SLAs, and you basically de-risk your whole integration.
Well, it fundamentally goes against the philosophy of being a product, isn't it? You build something in a standardized way and provide it to many people.
Indeed. It may be an option for the very same go-to-market reason. So if you can win a big logo with a 12-month time limit on your exclusivity, I think that may be viable. And especially if that bank put marketing money behind it, they make a fast integration, they actually ensure the adoption rate, then you can set some form of a standard for the banking functionality in a market, forcing the others to follow the hand rather than blocking the hand of others.
So coming back to the sales and marketing question again, I mean, not necessarily how you did it, but with the benefit of hindsight, if you were selling fintech at Series A, broadly, what kind of activities would you invest in? And I'll give you a little bit of a lead into that. I just had breakfast with another CEO outside of fintech, and he said that they have 19 content marketers and no one makes a single outbound phone call because the content makes them so known. And I appreciate that's at one end of the spectrum, and the others, you've got the diehard cold callers. So really just
Is
interested to
that
see.
B2B, that company?
Yes.
I think that's lunatic to spend 19 FTEs on content. I think content has one role to mitigate the risk and the perception of your business because nobody gets fired when they buy from IBM, but there is a risk buying from a startup or a scale up. So you can establish your brand and de-risk the perception of yourself, but I don't think you're going to generate buying decisions from it. One learning that I had was that when you're young and you're very proud of your product, you go into a meeting and you pitch your solution. So in Minna's case, we presented this as a customer benefit that your customers would be more happy when they can manage their spending easily. Excuse me. And that's one way of looking at the product because we do save a ton of time for the cardholder in the end. But the rationale behind the bank buying the product is to understand that the most common support ticket that the bank had was questions about recurring payments. And if the customer could self-serve their recurring spending in the app, they would not pick up the phone and call your back office. So the business model was built on a cost takeout model, which is actually measurable. And you also get a much clearer sponsor with who should pay for your product within the bank. Because nobody's going to pay for something that is a nice experience.
It's true, and I think actually in other areas of fintechs, that's that point has been really sorely felt in areas like open banking. You have features like transaction categorization, and it's a kind of a nice to have, but very few banks actually moved and bought it because building the business case is tenuous.
Yeah, and you're picking that as some form of a limited innovation budget that is supposed to increase NPS scores by 5 points. If you're actually presenting an OPEX takeout or an actual revenue increase, you can charge for your product based on value generated instead of a fixed price to give something nice. And value-based selling is always a lot easier than anything else.
Yeah, especially when it's easier to draw a straight line between the benefit or the return on investment.
Yeah, and if you're
So
looking at the US market, where the interchange revenue is not capped in the same way as in Europe and the UK, as a bank in the US, for example, we work with Capital One. For them to have your Spotify and your Netflix payment on a Capital One card, is significant revenue compared to you having that on a competitive card. So in the US market, the value proposition was completely different. It was not about OPEX takeout, it was about increasing payment volume on cards. So it follows the same red thread here to really understand the pain point that your sponsor is being measured on and how much can you.
Yeah. So you bring us on very nicely to the next area, which was international expansion. I mean, trying to crack the US is a graveyard of many companies, but you guys went there. What was that experience like?
Yeah, I only have one data point, but I disagree with that statement. Breaking into the US was a lot easier than breaking into the UK. European banks and UK banks is a lot more risk averse, and they are also much more reluctant to modern technology, ranging from storing things in the cloud to sharing of certain type of data, and how do you treat consent in different shapes or form. How do you expose PSD to APIs in compliance with the European regulation? Tons of things to consider for the buyer. In the US, it's a lot more risk willing. So I moved over to the States early 2022. By end of 2022, we signed Capital One, which by themselves has more than 120 million cardholders. So that logo had more cards issued than all our other customers combined. And remember, we were live in 6 markets at the time. One deal, more than double our reach, and that was signed within 12 months. Why did it work? I bought a one-way ticket. I bought my partner and the dog, flew to New York, drive down to North Carolina, and we rented an apartment blindly, didn't see it. But after that on, it's as Scandinavian, you actually have a lot of benefits stateside. We got a good reputation.
Yeah.
A lot of American salespeople promise the world. We have a tendency of actually keeping our promises.
Yeah. You highlight a couple of really interesting things. I mean, the first is obviously the scale of the US market within a kind of a single jurisdiction, which I think everyone acknowledges. But the second one is more interesting, which is their approach to risk. And you're seeing that talked about a lot in the news at the moment, particularly as it pertains to AI investments. Like the EU is just regulating the hell out of everything, and the US is innovating. And I think that's broadly the same thing that you're talking to, isn't it? That cultural attitude.
Yeah, it is also the perception of a salesperson in the US is that being a sales is a very good and valuable career. The perception of sales in Europe is somewhat belittling. Nobody wants to present themselves as a salesperson. Oh, I'm a business developer. Bullshit.
And so you stepped back. Was it 22 or 23 from leading the company?
I was stateside when we recruited an external CEO into the company. She was based out of the UK, Amanda Messler. She took over the CEO role, and I was basically heading the external relations.
So what was that journey to succession? Because I think that's something that every CEO knows exists at some point, or founder it knows it exists probably at some point in their future. But it's not really talked about openly outside of maybe CEO to CEO. So how did you get to the point where you thought, okay, I'm not the guy to lead this forward, and we need to find someone, and we need someone that looks like this?
In this case, it was actually pretty smooth sailing because we hired Amanda as a chairman before this. So we knew each other quite well. And then I was, as mentioned, stateside, and running a European business, considering the time zones, is a challenge. And it's also about realizing where your beachhead is and where your strong suits are. And I'm best with customers. So that's also a matter of experience in running organizations that are scaling. It's also a matter of where in the world you're located. Hey, that Minna was my first venture, and it was not her first venture.
But sometimes you can, and I've seen this, in the rush to go out and get someone with the right pedigree, quote unquote, you can lose the soul of the business prematurely. And sometimes that's just a part of growing up. But I don't think it's purely about competence. It's also retaining some of the DNA of what made the company successful. What do you think?
Emotional answer or rational answer?
Both.
Okay, let's start with the emotional one. Of course, I was incredibly proud of the baby that I nurtured from an idea to having close to no people resigning and everyone was sharing the same vision and mission. Was that the most efficient way to run a company? No. And remember, we are now talking 2022. We're talking post-COVID, we're talking inflation hike, and you start to consider cost, and you need to change the way you operate. I had legacy, and I don't think I would have been able to pull off some of the hard decisions that she could coming in without that legacy and those personal relations. I'm also a relationship person. So having someone that thinks a little bit more rationale to it, yeah, a change was needed.
Yeah. Okay.
Was it the right change for the business? Yes. Did it hurt? Also, yes.
Great. Yeah. Thank you. That's a really honest answer. So throughout the entire journey, I think a lot of the time we always talk about the glories once we pass the finish line and there's an amazing exit and you guys all celebrate that rightfully. And all of the difficult things almost kind of get lost in the annals of time. But what was the most difficult experience that you had from growing Minna?
Can I only pick one?
No, I've got as much time as you want.
I'll go chronological again. I think remember that we started as a B2C company. So we had our own brand and people downloaded our app to manage their subscriptions. It was very hard to monetize individuals. It was a nice experience. Willingness to pay was very low. And then the transition to start delivering the product as an integrated solution to the incumbent banks was absolutely the right decision. But the complexity of transitioning from B2C to enterprise grade and achieving PCI DSS compliance, ISO compliance, and all things security audits that it comes with. That was a challenging process, and it's a strength to be naive and not shaped by the box too soon in your career. Other challenging points, I think COVID did have an impact that we did not really give the credit to. So we signed Lloyd's Banking Group in 2019 or 2020. And after that, there was a couple of years without no major deal signed. So the next one actually was Capital One in the US in 2022. I think that period was also challenging, especially since we closed the Series B from Element Ventures about the same time as we closed Lloyd's. And then you got in new reputed investors who was expecting growth. And then you hit that 2-year hike without any major logos. That was challenging.
Was it purely COVID that you think kind of hit the brakes on everything, or were there wider things that, you know, with hindsight, actually you could have anticipated?
We did a lot of things wrong. Was too many features being built, was too many markets being attacked. And as a consequence of that period, a lot of things changed. So we said we're only going to do the UK and the US. And that was designed on the value created. So we know that the OpEx takeout in the UK was significant, and we knew that the revenue increase in the US banks was a great possibility. And that was enabled by research that we invested in by living through the challenge. And that was almost a Hail Mary that, well, I took my family and jumped overseas. I'd never been to the States, Christ's sake. So it ended up in a good place, but of course it was a very risky move. And if we wouldn't have won the American deals, well, the M&A would not happen either.
Mm-hmm. I think you make a great point around the strength of the business case, because that's really where you built your core markets, is where the business case was tangible. And it's also something I've seen a lot of businesses that sell to banks misunderstand, is just because something has a net positive business case doesn't mean that that will secure a purchase, especially considering all of the other things that the bank needs to do. The 100 other initiatives competing for the organizational bandwidth, and you've got to have something that is a must buy rather than a nice to buy.
Yeah, and you really got to be a chameleon in terms of speaking different languages as part of your sales process. So I remember when we closed ING in Belgium, I was still living in Sweden at the time, and I met more than 70 people face to face as part of that sales process. And they're based in Amsterdam and in Brussels. And when they are taking the decision in some form of a committee, you're going to have compliance in the room, you're going to have InfoSec in the room, you're going to have the business in the room, you're going to have some digital experience people in the room, senior management, XYZ. And in most cases, each of these departments that will get impacted by a potential purchase of your product has a veto. So one single no can ruin 2 years you spent on closing that deal. So I would say that a healthy sales pipe for someone doing enterprise sales is 2 or 3 logos. That's what you can work with in parallel. And if you find yourself, well, oh, I don't have anything to do today, get on a plane, sit in their lobby, shake the hands, go on a lunch, understand who their influencers are. So, okay, ING in Belgium, they are consulting with KPMG or EY. Okay, go and get to know those guys because they can speak in good words about you behind closed doors or whatever it may be. It's basically a social game of chess at that point.
You raise a really interesting point, which is the complexity of selling infrastructure to banks. I mean, it is the purest type of enterprise sales in my experience. Did you have a technical sales background? As you said, you started Minna in college. So were these skills that you just learned or that you brought into the business?
But I've always been a hobby engineer. I can read code, but I don't write code. I can speak as a sales engineer, and I think that has helped me a lot. I do speak English, which is also a great benefit, even though it's not my native language. But being able to speak with these different stakeholders that I just mentioned, getting into a room with a legal representative and understanding what limit of the limitation of liability risk that the bank will be exposed to. Can I address that conversation? And back to back, go into another room, someone who cares about our hosting solution and encryption keys. So being versatile in those conversations is challenging to find people who can speak across all dimensions.
And that's the superpower of the founder-led sales, isn't it? You know everything about the entire business, and moreover, more than just understanding, you are empowered to make decisions. If you just took something like liability, it's within your power to make compromises to get those deals across the line, and that's very difficult to distribute that early on.
And when you have a healthy level of understanding within each of these domains, I can understand that if there is a change request to this technical feature, I can make a judgment call in that meeting to understand, is this a reasonable size of work or not? And in terms of risk exposure, would changing that value to that value actually provide any significant risk to us? True or false? So as a founder, you always have information advantage.
There's one other thing that you've raised, and I think this is a business problem that's actually causing and will continue to cause problems for some fintechs. Is all of those the sales cycle you describe is expensive, whether it's you or whether you're a little bit more mature and you've got lots of people in pre-sales and architects and all of the people doing those things. It costs a lot of money, and if the ticket value of your solution doesn't justify the enterprise sales motion, you don't have a viable business, do you?
No, but I think that's on the good side of enterprise sales because even if you're going to spend three full-time employees over 3 years and you look at that cost of sales, and then you're looking at a customer with a very strong balance sheet that is most likely going to stick with you for the upcoming 20 years. So I started Mina 12 years ago. In 12 years, we had one churn. So the lifetime value of those logos we closed is still growing. So I have no problem with a company investing £4 million in winning a deal because that's, well, depends on your sales price, of course, but your LTV is going to be a lot higher.
Yeah,
I dare to
it's very
say that your
sticky.
cost of sales is most likely below 10% of the deal value anyhow.
Yeah, and one of the main metrics we use is the CAC payback period. But if you can hold on to that customer for a decade, you can tolerate those longer CAC payback periods.
Yeah, and especially if you have a pricing model that is based on the usage, because then you can also work alongside that customer to increase the adoption rate on the bank side. So in our side, we started with a fixed SaaS model. Bad, very bad. If you have a high adoption, you are the loser. If you have a low adoption, the bank is going to be disappointed because they still pay the same price with low value. So having a price per use or any form of a performance-based model also allows you to increase your monetization of your existing logos. And that's even more important when you get 2 years to the next logo. Well, make sure that you can increase revenue from what you already have.
Yeah, you can use them in combination. So my final question, Joachim, is if you were talking to another founder, perhaps literally just at the beginning of their Series A, and you could just give them one piece of advice, what would you tell them?
Recruit a co-founder.
I thought you might say that. Fantastic. Joachim, thank you very much for your time and your candor.
Thanks, James. Been a pleasure.